In Houston, Texas, a new kind of giant was born, rising from the flatlands like a shimmering mirage. It wasn't built of brick and mortar or forged in the fires of industry. This giant was something different, something altogether more ethereal. Not of steel, but of ideas. This was Enron, a name that would soon echo through the halls of Wall Street and the living rooms of ordinary Americans. A name synonymous with innovation, ambition, and ultimately spectacular collapse. Formed in 1985 from the merger of Houston Natural Gas and Internorth, Enron looked like just another energy company, a regional player in a well-established industry. The merger itself was unremarkable, just another corporate consolidation in the booming 80s. But its leaders, particularly a man named Kenneth Lay, saw energy as something more than just a commodity to be extracted, processed, and delivered. They saw it as something to be traded, speculated upon, and financialized. They envisioned a future where risk itself was a commodity, a tradable asset that could be bought and sold like barrels of oil or kilowatt-hours of electricity. This was a radical idea, a fundamental shift in how the energy industry operated. Enron quickly shed its pipeline roots, divesting its traditional assets and transforming into a financial powerhouse, a trading giant that dwarfed its competitors. The old business model was out, the new financialized model was in, and market maker for everything from electricity to weather derivatives, from bandwidth to broadband. If it could be quantified, Enron would trade it. They were pioneers in the world of energy deregulation and financial innovation. Wall Street was dazzled by Enron's rapid growth and innovation. The company's stocks soared, reaching dizzying heights as analysts and investors clamored to get a piece of the action. And it became a symbol of American ingenuity, a testament to the power of deregulation and the boundless potential of the free market. Enron was the future, or so it seemed. Enron's narrative was carefully crafted. It was more than profitable. It was smart, the future of business. They sold a vision of a new kind of corporation, one that was agile, innovative, and relentlessly focused on growth. Its Houston headquarters became a shrine to modern capitalism, a gleaming monument to ambition and success. The building itself was a statement, a physical manifestation of Enron's soaring aspirations. Filled with ambitious minds and a language of innovation, a place where young, bright professionals were encouraged to take risks and push the boundaries of what was possible. But beneath the surface, Enron was less an energy company and more a Wall Street investment bank, a complex web of financial transactions and off-balance sheet entities. Its real profits came from complex financial contracts, not pipelines, from trading strategies and accounting maneuvers that were often opaque and difficult to understand. Enron was a trading company, a tech innovator, and a venture capital firm all at once, a chameleon-like entity that constantly reinvented itself to stay ahead of the curve. This complexity was its allure, and its shield, a way to obscure its true financial performance and keep regulators and investors in the dark. The very intricacy that made Enron seem brilliant also made it nearly impossible to understand, even for seasoned financial professionals. The more complex it became, the less scrutiny it faced. Investors, analysts, and the public bought into the story, rarely questioning the details, seduced by the promise of high returns and the charisma of Enron's leadership. But within this web, a dangerous seed was planted, a seed of greed, hubris, and ultimately, fraud. Complexity became the perfect cover for deception to grow, hidden in plain sight, masked by layers of financial engineering and accounting trickery. The bigger Enron got, the easier it was to hide the rot within. At Enron's center, a figure of immense influence and power stood tall, Kenneth Lay. He was the founder and chairman, the driving force behind the company's meteoric rise. Lay, the son of a minister, armed with a PhD in economics, possessed a unique blend of charisma and intellectual prowess. He seemed to perfectly embody the American dream, a self-made man who had risen to the pinnacle of corporate success. He was a visionary leader, a fervent champion of deregulation, and a true believer in the transformative power of free markets. He saw a future unburdened by regulation, ripe with opportunity. LA's ambition wasn't confined by borders, it was truly global. He envisioned Enron as a dominant force on the world stage. Enron, under his guidance, would not just participate in existing markets, but actively create and control entirely new ones, trading in anything and everything of value, from energy to bandwidth. He sold this audacious vision with undeniable charm and unwavering conviction, winning over legions of investors who eagerly bought into his promises. He cultivated relationships with powerful politicians, securing crucial support for his deregulatory agenda. And he inspired unwavering loyalty from his employees, fostering a sense of shared purpose and collective ambition. Lay deliberately fostered a corporate culture that celebrated ambition, encouraged innovation, and rewarded risk-taking. He constantly urged his people to think big, to challenge the status quo, and to push the boundaries of what was possible. Under his leadership, Enron became a significant philanthropic force in its hometown of Houston, generously supporting local charities and community initiatives, building a substantial reservoir of goodwill. But behind the carefully constructed public persona, a more complex and troubling reality was taking shape. Lay presided over a corporate culture that was growing increasingly aggressive, competitive, and in some corners, even ruthless. Success, within Enron's walls, was increasingly measured by one overriding metric: the relentless upward trajectory of the stock price. The pressure to deliver consistent, impressive short-term gains became relentless, fostering an environment where ethical considerations could easily be sidelined. LA's grand vision undoubtedly inspired many, but it also inadvertently set the stage for the company's eventual, catastrophic downfall. The obsessive focus on appearances, on projecting an image of unwavering success, ultimately overshadowed substance, creating a fertile breeding ground for unchecked risk-taking and outright deception. Lay built the dream, a dazzling edifice of innovation and ambition, but in doing so, he also laid the foundation for its spectacular and devastating collapse. If Lay was the dreamer, Jeffrey Skilling was the architect. Skilling, a Harvard MBA and former McKinsey consultant, transformed Enron into a financial innovator. His gas bank idea turned natural gas into a tradable financial instrument, pushing Enron deep into abstract finance. Skilling recruited the smartest guys in the room, fostering a culture of intellectual arrogance and relentless competition. His brutal rank-and-yank review system made Enron a cutthroat environment, where risk-taking and the appearance of success mattered most. Greed was celebrated, collaboration was secondary. Skilling's Darwinian worldview permeated the company, rules were for others. Enron's leaders believed they were rewriting the rules of business and ethics. In this environment, the seeds of disaster were sown. Skilling's most destructive innovation was mark-to-market accounting. Instead of booking profits when cash was received, Enron claimed all projected profits from a deal the moment it was signed. This allowed Enron to conjure earnings out of thin air, based on optimistic internal models. The company's financial statements became a fantasy, detached from reality. The pressure to show ever-increasing profits led to riskier deals and more aggressive assumptions. Mark-to-market created a vicious cycle. To beat last quarter's numbers, executives had to invent even bigger profits. The company became a house of cards, built on hypothetical future gains. As long as the deals kept coming and the stock price rose, no one questioned the numbers. The illusion of endless growth was maintained until reality caught up. Enron's profits were a mirage, and the truth was closing in. The foundation was crumbling beneath the surface. As Enron's losses mounted, CFO Andrew Fastow engineered a way to hide them. He created off-balance sheet entities, shell companies like LJM and Raptor, to absorb Enron's debt and bad assets. On paper, these were independent. In reality, they were controlled by Enron and Fastow himself. Fastow personally profited from these deals, negotiating with himself and earning millions in fees. This staggering conflict of interest allowed Enron to present a false picture of financial health. The debt and losses didn't disappear, they were just hidden. For a while, this financial engineering worked, keeping the stock price high, but the web of shell companies grew too complex and heavy to sustain. The truth was buried in layers of deception. When the structure began to unravel, the hidden losses came rushing to the surface. Fastow's schemes were a ticking time bomb. The explosion was inevitable. Enron's numbers were meticulously signed off by Arthur Andersen, one of the world's top and most respected accounting firms. Andersen was supposed to be the watchdog, ensuring transparency, but it was also a highly paid consultant, earning millions upon millions from Enron. This inherent conflict of interest eroded any sense of objectivity. Instead of challenging Enron's aggressive accounting practices, Andersen often helped justify it, enabling the deception. They approved mark-to-market and Fastow's shell companies, even as internal concerns grew louder. When the scandal broke and the truth began to surface, Andersen executives ordered the immediate destruction of Enron audit documents. Thousands of incriminating pages were shredded in a desperate and illegal cover-up attempt. The watchdog didn't just fail, it actively became an accomplice. Andersen's own downfall was now irrevocably sealed. For years, Enron seemed untouchable, but by 2001, the cracks were showing. Failed ventures and mounting losses became harder to hide. The shell companies, propped up by Enron's stock, began to collapse as the stock price fell. In August, CEO Jeffrey Skilling abruptly resigned, sending shockwaves through Wall Street. The confidence that had fueled Enron's rise began to evaporate. Journalists and analysts started asking, how does Enron actually make money? In October, Enron announced a massive loss and a $1.2 billion reduction in shareholder equity, linked to Fasto's partnerships. The magic was gone, reality was bleeding through. The SEC launched a formal investigation. Credit rating agencies finally downgraded Enron's debt, triggering a financial death spiral. Billions in debt came due overnight. The company was hemorrhaging cash, its stock in freefall. Trust vanished in weeks. The unraveling was unstoppable. The final months of 2001 unfolded like a slow-motion train wreck, each day bringing fresh revelations of deceit and mismanagement. The air was thick with anticipation, a grim countdown to an inevitable reckoning. Saw Enron's spectacular collapse. It wasn't a gradual decline, but a swift and decisive implosion, a testament to the fragility of even the most seemingly invincible empires. The world watched in disbelief as the giant crumbled before their eyes. The stock, once a darling of Wall Street trading at over $90 a share, plummeted with breathtaking speed, eventually falling below $1. It was a free fall, a complete loss of investor confidence, a clear indication of the rot that had festered within the company's core. A last-ditch rescue attempt, a desperate gamble by Dynegy, ultimately failed to materialize. The deal collapsed under the weight of Enron's hidden liabilities and questionable accounting practices. The rescue faltered when the true extent of Enron's financial hole, a gaping chasm of debt and deception, was finally revealed. The numbers simply didn't add up, and the truth was far more damaging than anyone had initially imagined. On December 2nd, Enron filed for bankruptcy, a monumental event, the largest in U.S. history at the time. It was a day that would forever be etched in the annals of corporate scandal. 20,000 employees, dedicated and hardworking individuals, suddenly found themselves out of work. Their jobs and savings vanished in an instant. Many of these employees had diligently invested their retirement savings in Enron stock, trusting in the company's future, only to see their nest eggs evaporate. Executives, meanwhile, had actively urged employees to buy more stock, painting a rosy picture of the company's prospects. All the while, these same executives were quietly selling their own shares, profiting handsomely while leaving their employees to bear the brunt of the collapse. Dreams and livelihoods built over years of hard work and dedication were destroyed overnight, leaving a trail of devastation in their wake. Investors, both large and small, lost an estimated $60 billion, a staggering sum that represented the collective wealth of countless individuals and institutions. The collapse sent shockwaves through the markets, shaking investor confidence and raising serious questions about corporate governance and regulatory oversight. The Enron scandal raised fears about the stability of other corporate giants, prompting increased scrutiny and a renewed focus on ethical business practices. Enron became synonymous with greed, fraud, and the abuse of power, a cautionary tale for future generations of business leaders. Its once iconic logo, a symbol of innovation and success, was transformed into a stark reminder of corporate malfeasance and ethical failure. The company's once bustling headquarters became a ghost town, a silent testament to the devastating consequences of unchecked ambition and corporate greed. Ordinary people, engineers, secretaries, accountants, and countless others, were the ones who ultimately paid the price for the company's sins. Their lives were irrevocably altered, their futures uncertain, their faith in the system shaken to its core. They had placed their trust in Enron, believing in its mission and its leadership, only to be betrayed in the most profound and devastating way. The fall was not just a financial catastrophe, it was a deeply human tragedy, with far-reaching consequences for individuals, families, and communities. Enron's story became a cautionary tale, a stark reminder of the importance of ethics, transparency, and accountability in the world of business. After Enron's collapse, the nation demanded accountability. Investigations by the DOJ, SEC, and Congress followed, unraveling one of the largest frauds in history. Arthur Andersen was the first casualty, convicted of obstruction for shredding Enron documents. Though the conviction was overturned, the firm was finished. Attention turned to Enron's leaders. CFO Andrew Fasto pleaded guilty and testified against his former bosses. The 2006 trial of Ken Lay and Jeffrey Skilling was the main event. Both were found guilty of fraud and conspiracy. Skilling received over 24 years in prison. Lay died before sentencing. Fasto served 6 years for his cooperation. More than a dozen Enron executives went to prison. Justice was slow, but the message was clear. White-collar crime would be punished. The Titans had fallen. Enron's scandal was more than a single company's failure, it exposed deep flaws in the financial system. Congress responded with the Sarbanes-Oxley Act, imposing strict new rules on corporate governance and accountability. CEOs and CFOs now had to personally certify their numbers. For a while, investor confidence returned and blatant fraud became harder. But have the lessons truly been learned? The financial world is now even more complex and fast-paced. The 2008 crisis proved that greed and lack of transparency still threaten the global economy. The drive for endless growth and the temptation to hide risk remain. Regulations have been challenged and weakened. The question lingers. How many more Enrons are hiding behind the numbers? The story is not over.